Taking its time. It's about halfway there. It just sets up the movie. Okay, we're good. Taking its time. Hey, everybody. Are you ready to take control of your financial future? Thank you so much for joining us for part 1 of 4 of our financial literacy webinar series in collaboration with Monika Jazyk from RPI Education. This is designed to give you the tools, the strategies, and the knowledge to build lasting wealth. Each session that we're hosting features industry experts who'll break down complex financial concepts into practical and actionable steps. So whether you're looking to grow your real estate portfolio, optimize your tax strategy, or leverage mortgages for financial gain, this series is for you. Today, we're going to be talking about the importance of financial literacy with Monika, as mentioned, co-founder of RPI Education, which stands for Real Property Investment, if I'm correct. We'll be going through some questions for the first half of the webinar, then opening it up for guests. But as mentioned to anyone that was on us before, if you have a burning question and we're in the moment, you've got a question, please jump in and ask it. We just want to make sure that you are comfortable and you don't miss that opportunity. And before we get started with the questions, I'm also just going to go through a really brief disclaimer. So the views represented on this webinar are for general information only and do not constitute investment or professional advice or an offering of securities. The hosts and guests featured on this webinar make no representations as to the performance of any particular investment, and should you decide to go forward and make an investment of any kind, you're responsible for conducting your own review and analysis. It's highly recommended that you obtain independent legal, accounting, and tax advice from licensed professionals before you make any investment. So with that said, thanks to everyone for joining us, and of course for Monika for co-hosting with me today. How are you?
I'm great. How are you doing?
I'm doing great, thank you. It's the snow has stopped, so I was a little surprised to wake up to that this morning.
It's a little cold, but we're here, and I'm super excited about our first part 1 of part 4 series. It's exciting.
Absolutely. So let's dive in. So obviously financial literacy is so important. It's actually Financial Literacy Month right now. So April is a good month to dive into all of this. And I think it's something that is so important because a lot of the times people learn these things in school and they're not actually taught the nitty-gritty ways to manage your financing, how to budget, how to build wealth, how to invest properly. And in fact, even a lot of the people we know in our communities maybe lack some of the business sense and fundamentals to be successful. So for someone that has been successful and is educating others to be successful, I thought this is a great introductory topic to dive into. So in terms of financial literacy, why do you actually think that this is overlooked so often when it comes to traditional education and schooling?
So it's funny that you asked that because the government sets it up so it's led to believe actually that the government's recently done a $60 million investment into financial literacy into our schools. So most parents, they always say to me constantly, why aren't we learning these sort of things in schools? And the government is now putting financial literacy programs into schools, but are they really putting financial literacy programs into schools? Are they doing what people actually need, or are they doing programs that what we kind of view at RPI Education as outdated, archaic, and traditional financial planning, which really does not work anymore?
Like pushing
So,
RSPs.
and some of the things that they're learning in schools are incredible, that they're teaching in financial literacy, but it's also a little bit of overkill. So my daughter, for example, came home and she said, well, I'm learning about interest rates and compound interest and all these things. And that was phenomenal. I mean, like Albert Einstein says, one of the natural wonders of the world is compound interest.
Yeah.
But in reality, when you're 12 years old, what does that really mean to you in regards to financial literacy? Yes, it's a
Yeah.
great learning point and stuff, but financial literacy really has to be more extensive than what the schools were currently providing, which was nothing. And now what they are currently providing, one of their number one examples was how teaching children how to balance a checkbook. So we might still use checks time from time, but our kids are now taking pictures of checks and putting them in. So no one's balancing a checkbook. So I
Right
don't know
beside the
how,
rotary phone.
where's all this money going is the
Yeah.
question on
Yeah.
what sort of, financial literacy strategies. So it'd be great if the schools really got it right and were really kind of able to start implementing it and weaving it through the curriculum. And I
Yeah.
have worked in curriculum development before. So kids get a really understanding of money, what money is,
Yeah.
and how it works. And the programs that we've created have really have that sense of familiarity. So when they leave school,
Yeah.
they kind of have some understanding of what to expect as young adults in the working world.
Yeah. And I
Right
think
now,
it's
they
the
don't have
reality is
to.
that some parents are not actively involved in educating their kids in this way. And I just speak from the standpoint that I'm involved with the school board where my daughter is. So I'm on the parent involvement committee, but at the school board level. And we've actually hosted a series of financial literacy events for parents to like have the coins, have the money, try to teach kids. And to be honest, like just there's not the attendance that we'd like to see, right? So
Yeah.
I know parents are busy. But it really begs the question, like, are they setting their children up for success when it comes to understanding the ins and outs of money? I think people are maybe talking about it more now, but it was really not something we probably grew up talking with our parents too much about, like what they brought home, like what their expenses were, like what they were doing to invest for their future and stuff like that, right? So I think it is very, very important, especially with cards, because you don't have that physical money as much maybe as you did when we were younger, right?
And also remember, most of the parents aren't applying these financial literacy techniques that actually work.
Yeah.
So if you don't know how to do it, that's at RPI Education. We're doing this for adults. So when I go
Yeah.
into the schools and work with kids, I'm
Yeah.
like, I teach adults this.
Yeah.
So
For
it's
your
not just
kids.
for kids.
Yeah. Yeah.
So it's kind of hard to teach your kids and model those behaviors if you're not even doing it yourself. Now, another thing that's a little more controversial that I will bring up of your question of why is financial literacy really not taught in schools and what people need to
Yeah.
know is schools are actually designed to create employees
Yeah.
largely. And they
Yeah.
are institutional systems that have been put in our society. Primary, the first goal is to get kids out of the workforce and keep them safe. Now we're training them a multitude of skills as times go on. But they're
Yeah.
really kind of getting those kids into that 9 to 5 or 9 to 3. It always amazes me the school day is 9 to 3 and everyone's work day is 9 to 5. Someone needs to change that.
Yeah. Yeah.
But puts them in, gets them in that role. And then really, so a lot of the times if we have to be very careful when we go to schools as well. And there's nothing wrong with being an employee and having a job. Like we
Yeah.
need that.
Yeah.
But the way that the government often designs and creates programs comes with a sort of a different hidden agenda
Yeah.
of what they're doing for society in the long term, opposed to what people really, really need in regards to wealth and wealth building.
Well, and I think the reality is just because of the pace inflation, a lot of employment opportunities are not keeping up with that. So you see people that, they're making so-called good money, like 100,000 today is not what it was 5 years ago, right? So a lot of people are really struggling to keep up. And then there's also the risk of the fact that it's just your only source of income. So if you don't have other investments, if you lose that source of income, it's going to be that much more challenging to bounce back on your feet. So I think it really begs the need for all this education around other ways to invest. Now, you obviously have worked with a lot of people through your experiences with RPI. What would you say are some of the biggest financial mistakes that people are making because they're not educated appropriately?
So the biggest mistakes that people really are making, one, they're trading time for money. So that is a huge mistake. And like you were saying, in this, most people are not making enough money. A lot of them, they want to make more money. The first thing to do is they go out and they get a second job or a second income stream
Yeah,
that is actually a work income stream. So a lot of Canadians are working 2, 3 jobs and they're trading time for money and they're getting taxed on all that money and they're actually losing probably more money than they would be if they had the first job to begin with. So that was the first big thing that they're doing there is trading time for money. The second thing that most Canadians are not doing is they're not having different residual streams of income. They're counting on their job as their only source of income. And that's almost impossible to do. We often say at RPI Education, you really need to create 7 streams of residual income.
yeah,
And it's a kind of a fun game to think about, what are these 7 different things that I could be doing
yeah.
to continuously, be bringing money in that are not just from my job income and not just trading time for money.
And
And
I
the
would just to add to that point about the 7 streams, because I was someone that really wholeheartedly believed in the strategy I had, and I thought, well, I'm diversified with 18 different streams.
yeah.
So yes, they were coming from 18 different sources, but they were all centered around real estate. And then the market has, kind of imploded in the last year or two. So a lot of those income streams have now gone off the rails. So I think it begs the question not only the number of streams, but also focusing on different markets and different areas, right? So you don't want to just be solely focused on one market like real estate, where you could have things maybe in the S&P, or maybe you have a self-directed fund for stocks. And there could be other avenues, or buying a business where you can create all that passive income, but really just going so far as to, insulate your risk by investing in different things. It doesn't have to just be, and it shouldn't just be one thing and one focus.
Yes, no, definitely diversification is key. I think Robert Kiyosaki has a good saying about that. He says, diversification is for people who don't know what they're doing. So if you have absolutely no financial literacy at all whatsoever, you should diversify as much as possible. Especially if you're a DIYer, cross your fingers and hopes it turns out well. Real estate, you're really right on there as well, though. That you cannot be all heavily invested in one pot. Fortunately, if you do know how to invest in different things, and you could even take real estate and do it, like you said, those 8 different ways, different types of real estate investment,
Yeah,
and really sort of mitigate your risk through different types, like say active investment versus passive investment,
yeah,
could be versus mortgage, versus lending. These could all be different types of streams of income that you could be bringing in from one main thing, which is real
yeah,
estate.
yeah.
But you're right. Like
Or
we
different
have to be
asset classes,
recession
different cities.
proofing.
Yeah,
Yeah, exactly.
yeah,
And we
yeah,
have to always kind of watch out and say, the best thing about what's happening today, and like what Warren Buffett says, is you could always see who's swimming naked when the tide goes out. And a lot of people in the real estate world have been swimming naked.
yeah.
And it's been a really, really tumultuous market.
And
But the
some have shame and others do not. Let's just say that.
I'm amazed that someone just pick up and then they go on and do the exact same thing, and they haven't even learned
Yeah,
from the
yeah,
mistake. They will do the
yeah,
exact same model. And you have, as an entrepreneur and an investor, you have to consistently be like recession proofing your financial umbrella.
yeah,
And you also have to be learning, because it's not that making mistakes is a bad thing. I mean, we wrote Real Estate Mistakes, a book on real estate mistakes. You shouldn't be ashamed of making mistakes and learning.
yeah,
But shame on you if you do it twice. So if you're not learning from your mistakes, then
yeah,
you probably shouldn't be doing it. And that third thing that people aren't doing is they are continuing to invest and think that they have to save money. And that's the way to go. And when they have enough money, then they're going to start becoming investors, where we have to actually, they take their money and they save it first or try, but no one has any extra money to save this day and age. And people have to learn how to pay themselves first.
yeah, yeah. No, absolutely. What would you say are some of the basic financial principles that help people that achieve that kind of long-term wealth and financial freedom that everybody's after?
Well, at RPI Education, we focus on helping people invest like the top 2%. Those are the people that we always emulate. And those are also the people who make great fortunes in times like this, like we're experiencing today, like in 2008, like
Yeah,
in the Great Depression.
yeah,
And it's just because they think of money and think of things a different way, and also diversify themselves in different types of income streams. So one of them would be they all invest in real estate.
yeah,
And not everyone has to be a full-time real estate investor, but every Canadian needs real estate in their portfolio. And I'm talking about active real estate, even one investment property can help transform your entire real estate portfolio, or your entire financial future, I should say. It
yeah,
could help you have a multi-million-dollar retirement. It could help you make more money every month. And it could also help you help your kids out. And those are the 3
yeah.
main problems that we help people with.
Yeah, I'll give you an example that was actually mind-blowing to me. I'm working with a couple that bought some land 20 years ago. They bought it for 250,000, and it's looking like it would probably sell around 10 million. Like, that's crazy. Like,
Wow.
they bought this land, it's being leased to a farmer in a small portion, so they're only paying maybe $400 a year on taxes, and it could be selling to like Amazon or something
Yes.
like it just was like blew my mind, right? Like, if you knew now what you know then, I would have bought 10. You know what I mean?
Exactly, exactly. And you don't, but the funny thing is we always have to go, like they say, there's no, timing that market. There's just time in the market. And if you can't do what you saw 18 or 20 years ago, we gotta got sort of see
Yeah,
what we could do today.
yeah,
But yeah, they need to start investing in real estate. And they also need to start understanding how mortgages and strategic leverage work.
Yeah.
We're trained here, financial literacy is debt is bad. So debt is not bad. Debt is actually good. You could have used debt. If you use debt to buy liabilities,
Yeah.
like consumer debt, that's bad. But if
Yeah.
we're but using debt to buy assets,
Yeah.
then that's fantastic.
Yeah.
So strategic leverage is something that the wealthy use. They're not going to just save their money and let it whittle away at a 1% bank account interest
Yeah.
rate. Well, the bank takes their same money and buys real estate mortgages and insurance.
Yeah. You're amortizing in reverse.
Exactly. So it's very, very rare that the ultra wealthy is going to have their money just sitting there. They're going to have it working for them and utilizing debt when they can.
Yeah, and I
Uh,
think to your point, I think that's something that people need to consider is that, all things are not considered equal, right? So if you go and put $1 million into the stock market, you only have really that $1 million in assets or whatever that is or value, and you don't necessarily have the asset to back it up. But with real estate, you can come in with 10% or 20%, or with MLI Select, maybe 5%, maybe for 100,000 buy something worth $1 million.
yeah.
Well, you bought something worth $1 million with your 100,000, and over time that will get paid down with your tenant. So you can really stretch your dollar like so much further than you could if you just went and dropped it into mutual funds or into an RSP, right? So I think that's something that
Absolutely.
people just need to keep in mind, and how and why that can be so tremendous in terms of your long-term financial future.
It's so tremendous. And it's the only investment out there that really allows that amount of leverage.
Yeah,
No other investment you can leverage. And it really kind of extends that buying power. And real estate, like you said,
yeah,
is the most powerful tool.
yeah,
The third one's also passive investments, like self-directing registered funds.
yeah,
So our big mistake was just doing mutual funds, and this is what most Canadians do. They set it
yeah,
and forget it,
yeah,
do mutual funds, and then I can only imagine how those are performing now. But I know in 2008, we lost everything through
yeah,
that. So people can have control. They can take these funds that they've saved so hard for, but they can learn to how to self-direct them, invest them in passive investments, invest them in private lending, do arm's length mortgages and loan them as down payment, or be joint venture partners. There are so many things that people can do with their money. The ultra wealthy are not just setting it aside in the everyday, mutual fund market with some low-end advisor managing. So that's the third thing. The fourth
yeah.
thing is insurance. And I know we have a whole
Yeah.
series on that.
I
Insurance
know.
is
I feel
very,
like
very
when
exciting.
I learned about that kind of insurance that we'll talk about, I believe in
Mhm.
webinar 4, my mind was like, like, why didn't I know this? Like 2 years ago. And then the irony was I even had a policy that was like that, but the advisor I had never really educated me on how you really use that properly. And
Right.
just again, thinking back again, knowing now what I should have known then, things could be very different just because I could have been taking advantage of that probably 15 years ago, right? So I think who you work with can have such a big impact on how you're going to put these things into use and how you implement them to take advantage, right?
Absolutely. Like it's these different types of strategies that you can get into. And like making sure it's done the right way. Because I know insurance was something it was probably we're newest at insurance. That's our most recent
Yeah.
investment, even though we are, quite a bit ways in.
Yeah.
I really avoided that one for a long time, and gratefully so, because it was all the wrong kind of people. It was a bit of a business. Same with all of this stuff. When you're learning new things, you want to make sure you're in the right company.
Yeah.
But insurance is
Yeah.
something, the key to insurance is if you can use it while you're alive and not just when you're dead, it could be a tremendous
Which is something the
wealth
average
builder.
person has no idea you can do, right? Like you think I'm going to have
Exactly.
this policy to take care of my family when I'm gone. And a lot of people even resist it because they maybe aren't comfortable with that topic. But there's so much potential with it. So I
There
can't wait to
is.
dive into that topic in more detail.
And until you invest in it, you have to at least have term.
Yeah.
And if you are not having term and you own a house and
Yeah.
you have assets and you have children, go out and get a term policy
Yeah.
until
Yeah.
we teach you how to do the insurance the right way. Because at the bare minimum, you need to at least have your term and sometimes you can still have term alongside others as well while other things build. But
Yeah.
insurance is something, and then use of proper corporate structures is huge. So middle class and people own everything. The upper class and wealthy own nothing.
Yeah.
So we want everything transferred into proper use of corporations and structures. And to do number 6, which
Yeah.
really is to help mitigate taxes.
Yeah. Yeah,
The
no,
US,
100%. That was one
the
thing when
US can avoid taxes. Canadians, we can
well, let's just
reduce
say
taxes.
tax, tax optimization, right?
Exactly,
Like it was something
exactly.
when I sold my agency back in 2022. I could have done a share sale or an asset sale, and I pushed for the asset sale because I wanted to be able to keep all of my bank accounts and all my credit cards because of the credit attached to them. Like I had 20 years of credit, so
Mhm.
I had really robust value to that, right? So I knew like down the road when I want certain things, that'll all come in really handy. And, just being strategic with how that structure is, knowing that I can take advantage of all this tax efficiency.
Yes, and if you're not being tax efficient, there's no point of investing in real estate
Yeah,
because all that's going to happen is if you're not buying real estate properly and you're buying it in your personal name,
yeah,
and depending on what sort of real estate you're buying and what kind of strategy you're doing, but
yeah,
you're tacking that onto your income already, and you're a high income earner,
yeah.
well, bye bye.
Yeah, and also
The
the liability, right? So that's something that we'll talk about in
huge
more detail, but
liability.
you just want to be really careful with your exposure
Yeah.
because there's always things that kind of come along with that as well. Now, in terms of things like financial habits, what would you say are some of the key habits that you think successful people develop so that they can, create this wealth?
Well, definitely pay themselves first. So regardless of anything, they pay themselves first. So before you pay your bills, they have their investments account that are being set aside and paid. They definitely invest in health and fitness and mindset. And the reason for this is because you want to be an emotionally intelligent investor.
Mhm.
So investors and the key to financial literacy is not to do what everyone else is doing, but to have the awareness and understanding of how all this works so you could make your own decisions
Yeah.
and not panic. So when people panic, that's when the stock market crashes, and that's when things go down. Or even the real estate market during COVID was crazy because everyone said real estate's a great thing to do, and they had no problem overpaying for properties during those
I
times.
still don't
So
understand that. Like I understand the mobility, people are working from home. It's finally becoming widely accepted. The technology can support it. But looking back, when I think about some of the properties that I saw selling and how much they sold for, I'm like, I don't know, it must have been a psychological thing. Like you would think everyone's kind of staying in their house. They're like, let's move. Like, I'll
well,
never
the reason
understand
why
it.
6% of the population dominate the majority of the world's wealth is because most people are not very intelligent, unfortunately, in regards to the financial literacy. So it's really good to learn from people who and think like them so you can emulate them and get those similar results. And usually what everyone else is doing is probably not the right thing to do.
Yeah, yeah, makes
So,
sense. Now, when it
yeah.
comes to financial literacy, what kind of an impact do you think that this really has when it comes to generational wealth and economic mobility?
Well, the last key to wealth of the seven keys is estate planning. And estate planning is huge. And if you're alive, you have an estate. I know a lot of people out there, you might feel like I have no money. I have no assets. I have nothing, but you have yourself and you have your body and you are very, very important. And you are here and you're to learn and we're going to help you build. And so as you build this estate, you are your estate. You have to set yourself up, from a long-term perspective. So you want to start the way you want to finish. And so this all ties into, let's start with one thing is people need, to list their assets, and maybe they don't have any yet, but you have to have a living will. You have to have these instructions. You have to have sort of these sort of things with your estate. You have to set up these structures. If you plan to incorporate your kids into these sort of things in the future, you can have like rollovers for trusts or these sort of things. Doesn't have to do it right away, but in the future, continuously educate yourself on that. And then really always create your assets that you're going to be investing in, your insurance policies,
Yeah.
your real estate, your passive investments, all of that, and figure out very mindfully of how am I buying these assets and how can I actually create them and structure it so they could pass on not just to the next generation, but the next generation and then the next generation.
Now, I think it's also important to note with that is that you want to plan for the future, but also don't get ahead of yourself. I had a meeting with a real estate investment lawyer in the last few months, and they were talking about how sometimes people create these really elaborate
They do.
structures and they spend all this money. And then it turns out later they didn't really need it to be quite as
No.
complex as that. And vice versa. Like if people don't structure the right way, moving things around can be challenging. So you do want to work with the right professionals to guide you through that process so that things are balanced based on your needs and based on what your goals and objectives are.
And as you get into wealth building, it's going to be different every year. So you want a team that you could work with and grows with you as you grow. A lot of accountants will give you all the advice, oh, you're not going to do much. But you're only going to do one property, so to
Yeah.
speak. You know, you don't need to set up a structure. You do not need an elaborate structure, but I would still strongly recommend to set it up separately from your income.
Yeah,
It just
absolutely.
gives you more control. I know it costs more money in
Yeah.
regards to filing returns and doing things, but it's a very good safety measure to have, like you said, from a liability perspective, as well as a business perspective of what, and you don't know what's going to happen. You can add on to that corporation at later times. It can be very, very basic, but it's a very, very good way to start building.
Yeah, yeah, no, absolutely. Now, in terms of things like financial skills, what would you say are the top three skills that anyone should learn, regardless of their income level?
So the financial skills that people they all need to know is one, they really need to know their residual income. Okay. And so I'm sorry if you're not making enough money every month. Or are you? Most people don't even know how bad it is. They just kind of know it's pretty bad. And unless they have this budget that they're kind of, following, what your residual income is either negative, positive, or neutral. So how much money do you have left over after all your expenses are paid? If you're negative, you definitely need to make more money. If you're neutral, you still need to get more to get investing. And if you're positive, what are we doing with that residual income to create your best life?
Yeah,
Most people, you have to know your numbers. And so we have something called an investment binder
yeah,
at RPI Education that we have people fill out. And it really kind of allows them to put in all their assets, all their liabilities and as well as their income expenses, and calculates their net worth for them so they can actually measure and see where they're at and consistently be growing.
yeah,
But the most important number to really know is where are you after you really input all of those numbers, what is your residual income?
yeah,
That is the most important thing. And then the second thing that they have to figure out is what can I do to improve this? Most people in traditional financial literacy and financial planning say, cut expenses, cut expenses, cut expenses. This is not the 80s. Like you can only cut to a certain extent. There's going to become a time where you need to make more money.
yeah,
You need to know how much more money am I going to make? So if you map all that out and you see, wow, I have zero retirement savings, or I only have $76,000 in retirement. I thought I was doing really well, but at the rate this is growing, I might have $200,000 by the time I'm retiring, or I'm not making enough money every month. I'm sinking deeper and deeper into this hole.
yeah,
If you're not really acknowledging, and this goes back to being an emotionally astute investor, an adult, is it's time to put our big person pants on and see it for what it is. I'm
yeah.
sorry. It's kind of like going on the scale. You might not like the results, but
But you have to at least
they
be aware of
are.
it. I mean, that's kind of like bigger picture things. Like even when it comes down to the rudimentary items, like because I had so many different sources of income, like I would kind of track them all based on where they're coming from and the dates. Then I'd have all my estimated expenses and I'd always look at it every single month to be like, what's come in, what's going out, and then at least you know what you have to work with, right?
Well,
So
that's the
people need to
second
pay,
thing.
they need to pay
Track.
attention. Yeah, they got to track.
Mhm.
I'm like such a big believer in tracking everything because otherwise you just have no idea. Like you're walking in blind.
Absolutely. You have to just see those numbers for what they are. Who cares if you're broke? So is everyone else.
Yeah.
Yes, you're sinking in a hole. That's okay. Now you know. Now you could fix it.
Yeah.
And
As
if you're
Dr.
not
Phil would say, once you
tracking,
acknowledge something, you can change it.
exactly, exactly. And also the third thing to do really is you have to really, and I can't say this enough, is to really work on your mindset
Yeah.
and know that in reality, in the grand scheme of things, you have total control over your financial future. You are a free agent and you could do what it takes. You just need to have that calm mindset
Yeah.
as an investor, as an entrepreneur, there's going to be times where a lot of your bills might not be paid, mortgages aren't being paid, all this sort of stuff's sinking. You got to be calm in the middle of all that and be able to make good decisions.
Yeah.
And don't take a bad decision and turn it into a disaster.
Yeah. And take
Um,
action, right? Like educate yourself and take action. Because I think so often people sit on the sidelines and you don't know, you don't know.
yeah.
But really, all the planning in the world is not gonna help if you don't take that first step.
Well, educating yourself is definitely something, and that's something all the top 2% do as well. Unless you're born into it
Yeah.
and these things are just second nature to you, you should be part of a wealth community. You should be definitely taking education, taking courses, taking coaching, and everything we do at RPI Education is not get rich quick or no money, low money down. It really is real. That's why it's real property investments, but also current. So this is why we're holding people's hands and our team of wealth like community every other week on biweekly group coaching, talking about things that are happening, talking about the election, tariffs, taxes, markets, and whatever, and really coming up with people and helping them generate solutions in real time. I think that's what's really, really needed.
Absolutely. Now, can you share an example, like more about your personal journey? Because obviously, for anyone that's tuning in now, they may not necessarily know where you started and Vaughn started. Can you talk a little bit more about your journey when it comes to things like wealth building? I know you shared that you guys lost a lot back in 2008, but how did you come back from that to where you are now?
Oh my goodness, that's a long time ago. I feel like we're getting so old. Well, way back, our oldest is 21 years old. He's going to be this month. I was finishing my master's in teaching. So this is kind of funny with the financial literacy is I am an A4 qualified teacher, and I also have experience in curriculum development, which is probably why financial literacy is so passionate, why I'm so passionate about it and creating it in schools and programs. But when we were in our 20s and we had our first son, I was actually in the middle of completing my master's degree of teaching and basically had him finished off exams. And then everyone else raced and completed their final practicum. And I had a newborn baby, so I couldn't, but I had to do it within that 12 months. Otherwise, the degree is gone. So he's only about 8 months old, and I was in there in a classroom with 52 at-risk grade 7 students, which was pretty full on. And it was stressful at that time. I was a new mom, I was a new teacher, and I was also still a student because I was a grad student getting a lot of work done. And I sort of realized I was selling myself short in all of those areas. I wasn't the teacher I wanted to be, I wasn't the student I wanted to be, and I certainly wasn't the mother I wanted to be. And I felt like I left the best part of myself at daycare at 7 a.m. every morning so I could even be there to finish this.
Yeah.
So I hunkered down and I did it. It was a 12-week program, but the big learning lesson was that I don't ever want to spread myself thin like that again. And what I would like to do is be a stay-at-home mom for this kid and any other kids that we have added to our family. And now we have four. So good thing we made that decision back then. So Vaughn was obviously totally fine with that. He was great. We were living in Australia that time, so we made a global move over to here. And by that time, we had number two. And then we started becoming, financially adults. We're homeowners. We bought a house. We were learning all these things. And as the head of the household, we had two kids at this time. My goal really was to take those finances and put them to the forefront and manage, the finances. So Vaughn was making great money. He was making six figures, which was great at the time. And, working hard, trading time for money. We thought he was doing the right thing. We both have post-secondary degrees, did everything that we were supposed to do. And I followed Susie Orman, Wealthy Barber, all those different financial literacy books just to the T because I'm like an A+ student, right? And so we were taking money and saving it and putting it in accounts and opening up RESPs and RRSPs and company matching and trying to do everything the traditional way.
Yeah.
And it still felt like we never had enough money every month. And it still felt, like these things, it was really based on what we could afford to do, not
Yeah.
really. And it was a long-term growth strategy based on like a hope and a prayer strategy. And that blew up in smoke in 2008 when the stock market tanked and all these, funds pretty much, went over, just kind of imploded. And we realized we had to do something different. And
Yeah.
that's when we started, saying, let's invest in real estate. That's actually when we read the book, Rich Dad, Poor Dad, great for financial literacy. And it really it won't teach you how to invest in real estate, but it will like give you a brand new perspective on financial literacy and the lessons we learned from that book. It was just incredible.
Yeah.
So we definitely, that was the big pivotal moment where we decided to take control over our own financial destiny, start
Yeah.
educating ourselves on investing in real estate, and then start building wealth through real estate. And it was only active real estate at the time. And
Yeah.
from that point, there was a lot of lessons learned. We made a lot of mistakes as full-time real estate investors because we didn't have the support. We didn't have a community like RPI. We had to figure all this out on our own. And now
Yeah.
I just love being there to share with other people, oh, don't do that. You could try this instead. So
Yeah.
where were the people like that kind of had been there before us back in the day? We probably wouldn't have made those mistakes. But also, we
Yeah.
didn't know any of the other wealth concepts at that time as well. We did evolve into strategic leverage because we had to learn how to buy the real estate in the first place. But aside from that, I mean, we made mistakes in all those areas we already spoke about because we had no idea. And it's our wealth team of experts that really were the ones to correct us and are still here with us over a decade later, which is exciting.
Awesome.
Mhm.
Now, in terms of your portfolio right now, what does that look like?
So it's
If you're comfortable to
diversified
share
amongst
it.
it's diversified amongst all those of all those assets. So we definitely have active real estate. And we only focus now in high growth areas. So when we started out investing in real estate, we were doing like cheap properties and cheap areas like Timmins, Ontario. And I started making my fortune buying $40,000 homes and renting them out for $1,000 a month, which is pretty good cash flow. We could buy so many because they were so cheap and then convert it into apartment units. So our joke is at one point we were the mayor of Timmins.
Yeah.
Um, and this would be like 13 years ago, so a long time ago.
Yeah.
But that really, really was a huge learning curve. And now we are more on a $20 million portfolio based in 10 properties in high growth areas.
Yeah.
That is the focus.
And now,
Because
what market are you heavily focused on and what asset class?
so we are doing the BRRRR conversion. So we do single family to multi conversions,
Yeah.
and we do them in high growth markets like Toronto, like GTA, like Simcoe County, the St.
Okay.
Catharines area, as well as Calgary. Those
Okay.
are our Canadian markets. And in the US, we've done, it's actually a little different in the US, our investments there, but we've done land developments in Florida. So we have 20 homes in Florida, as well as we're doing some commercial developments and flex warehouse structures
Yeah.
out there as well,
Yeah.
medical developments, and also new build short-term rentals in different parts of Texas, some in Houston, some in New Braunfels, as well as Arizona. This is a really interesting market. So we do try to diversify, and we have teams of experts in each one of those markets, and that's just the active real estate. In passive real estate, where I'm very heavily invested in private market equity. I absolutely love it. This is how we self-direct. And
Yeah.
so in terms of larger investments like commercial properties, apartment buildings,
Yeah.
shopping plazas, I don't want to own that all on my own. I've had apartment buildings before, and you need an apartment building like you need a hole in the head sometimes. It was just very, very stressful. I'd like to, hand it to the funds and get great returns on those. So
Yeah.
unless we're developing it and actually building it, we are definitely doing it more passively.
Yeah.
Insurance has been huge as well. So we definitely take all those different sort of facets of wealth, like we spoke about. And the definition of wealth truly is how much money you're making when you're sleeping.
Yeah.
So I kind of try to remind myself of that
Yeah.
all the time, that it doesn't always have to be a more is more approach. We really
Yeah.
kind of focus on the less is more approach and the power of investing.
Yeah. Awesome. So on that note, I think we're about 40 minutes in. So if there is anyone here that's joined us that has any questions for Monika, now would be a great time to open them up, and then we'll wrap it up.
Excellent.
There's a couple people here. Jessica, Sadiq, there's another Monika. Anyone got any questions? Everyone's shy. All right. Well, in closing then, if nobody has any questions, is there any pearl of wisdom that you'd like to leave us all with today?
I think, I know we're going through very difficult economic times, but it's really important to realize that wealth building never stops. And we always have to be building wealth. It doesn't mean always buying buying assets necessarily, but it also means educating yourself. So
Yeah, no, absolutely. Well, for anyone that is joining us, Jessica just said thanks for the meeting. I enjoyed the information. We appreciate you joining us today. We will be back again for the next 3 Tuesdays in a row. So you can join us for some other topics, one on real estate strategies, one pertaining to corporate structures, estate planning and taxes, and also one on mastering your mortgages and strategic leverage. So make sure that you tune in for those. And again, thank you so much for your time today. And remember, when you invest in yourself, the sky's the limit. Thanks again. Just going to end our live stream.